What is up, guys, and welcome to this private lecture where I'll be giving you live trading examples applying the TCT concepts given to you in the exclusive high probability TCT schematic lecture. Okay, so we're going to be checking for those return to zones, those range inefficiencies, the breaks back inside the volume profile, the supply and demand chain creation, right? We're going to be watching for all those things and see what they look like in a real live trading environment so it all becomes way more clear. So starting off with Solana, I already put out the macro context for you guys. So we had a range, we have the range low, we have the range high, we have a deviation at the high, the deviation at the low. So from a macro standpoint, we have a potential distribution or accumulation in the making. Now, this green box right here is a 6-hour order block, as you can see, and this is a requirement to tap if you want to call it a valid high time frame model 2 accumulation schematic. Now, from there, our highest time frame market structure pool from the bottom up is basically a low, a high, and then we came back to the equilibrium, confirming this as a range. And we can also see that this is a very clear defined range with rotations from bottom to top and top to bottom. Now, from a macro standpoint, when we are looking for trades in this lower section of the range, technically speaking, yes, we are in the lower section of the range, but within the range on the left, there's nothing but sell-side liquidity, so there's nothing to hold price up if we want to look for an accumulation long to take it towards the premium pricing section. And also, we know if this wants to be a valid macro high time frame accumulation schematic, we need to come to this demand zone. So even though that we're in the discount section of this range, applying macro context on the chart, there's nothing to hold price up, and there are reasons to come lower from a liquidity and a demand perspective. So if we get a confirmation to go short, okay, it's definitely still valid to take because there are reasons to come lower from a liquidity and a demand perspective. And obviously, if we have a high probability setup itself, we can just neglect the bigger context and trade the high probability setup. Okay, now zooming in, what can we see on the 1 hour? So we can see on the 1 hour right here that we have a downtrend. Okay, we had that rotation. This wasn't valid structure. We had that rotation down, and then we had lower highs and lower lows. Okay, and right in that pivot point, we saw this 1 hour order block. So right in that pivot point, we saw this 1 hour order block with an inefficiency, as you can see, right? This candle did not tap that candle's low, creating that tiny inefficiency, making this a valid pivot point supply order block. Now, the way we came in to that order block for that potential lower high for the lower low, and that lower low could be extended towards the range low and even this demand zone because we just built a bigger context and we said there was nothing to hold price up. Okay, so from a context perspective, it's definitely valid to still look for a short because there are reasons to go lower locally from a liquidity perspective and a demand perspective, and then we're just going to check for any confirmations if we get those. Now, we came into that supply zone, okay, creating a Model 1 distribution. Okay, we can see that from the low up, we have this tiny uptrend, okay? And an uptrend we put from high to low. And right here, we have a 1, we have a 2, and then we extend our high to our deviation high, and then we have our 3. Guys, what I'm presenting to you right now is an absolute unicorn of a setup. So we have a Model 1, okay? And from a context perspective, we can go lower because there's nothing to hold price up, and we have liquidity below that we can grab, okay? And demand waiting even lower for that high time frame accumulation schematic. So from a context perspective, we can definitely look for a short, even though we're in the discount section of that range. We got to Model 1, where the third tap, okay? We got to Model 1 where the third tap grabbed that 1 hour order block. So from a supply perspective, following this downtrend, there's no reason to come higher anymore, okay? There's absolutely no reason to come higher. Then, applying the high probability variables to our trading confirmations, okay? If we check this range, what can we see from a return to zone perspective? in this move up, right? In this move up, there is nothing but liquidity. Absolutely nothing but liquidity. There's no demand in this lower section. All these lows are higher lows, and there's not even one order block in this move up that's unmitigated. Everything is mitigated. There's no demand. Even this tiny demand zone right here, it's all grabbed, okay? It's all mitigated. There's nothing but lows here. Nothing but stop losses, making the move down once that first low gets hit extremely easy, okay? So we have the return to zone check mark. That's one. Then, guys, if you look at this range, the moment we are right here, even without pulling your volume profile, what can you see from an inefficiency perspective? Is this range efficient or inefficient? Because we can clearly see right here that there is a gap in price. Okay? The moment we want to wait for that confirmation, there's absolutely no price action in the lower section of this range. Now, you can pull your volume profile to confirm it, but even when your volume profile sometimes overlaps a bit in that discount section, it's still a range inefficiency, because you can see there was a lot of volume in here, but no support. So in this situation, your volume profile did not particularly match the confirmation for an inefficiency, and that's when you just check with your own eyes. Is there a gap in price? And you can clearly see that this is 100% a valid range, but there is a gap in price action in that lower section. And even though there's volume in here, there's no demand, and this is just literally liquidity that will get grabbed very easily. So do we have a range inefficiency? Yes. Check mark. Okay. Now let's zoom in. So we're in a high probability area to look for a short based on context. So context is in our favor. We have to return to zone. We have the range inefficiency. So we're already talking about a TWT schematic, meaning we'll add a 2% risk on this trade once we get confirmations. Now, let's zoom in and check where is our market structure. Look at that. Drawing our structure. We have higher lows and higher highs coming into that supply zone, making this our market structure low. Okay? What we can see is that we had some sort of demand here. In this uptrend, you see these two local candles. We call this structure demand. Okay? This is structure demand. We're currently bouncing from structure demand, but we can also see that we have supply from the top down. We have that order block right at the top that caused that lower high, and then we're moving down. So preferably, we want to have a lower high right here and an aggressive break, indicating that supply is clearly in control and that demand is failing. If we break this low with an inefficiency, that is clearly an extra indication that the market makers are pushing price down aggressively, because only when they push price down aggressively, that's when you create an inefficiency. So what we can see right here is that the moment we break that low, okay, the moment we break that low, let's see, it's a 3-minute low right here. We have created a structure supply POI right here, pulling your structure from top to bottom. We can clearly see that we got that bounce from demand, okay, but then price put in a lower high, breaking structure and creating a valid structure supply area because we have that inefficiency right below it, okay? So at this moment in time, right on this break of structure, I want you guys to, grab your checklist and see what we have from all the variables I have given to you. From a context perspective, yes, we are in the discount section of the mid time frame range, but from a high time frame perspective, there are reasons to come lower because within the range, there's nothing to hold price up. There's only sell side liquidity lows to get taken. Okay, and from a macro standpoint, we also have demand lower. So there are reasons to come lower from a demand and a liquidity perspective. Then we come into a pivot point supply zone. So from a market structure perspective, from the downtrend, there are no reasons to come higher to put in that lower high. So that's all gone. That's all in our favor. Then the schematic itself, okay, the context is aligning. The schematic itself has a return to zone, one of the best returns to zones I have seen in a long time, guys. This was one of my craziest trades in the past month. It was, the past month, literally 1 month ago, one of my craziest trades. We have a crazy return to zone. We have a clear inefficiency in the lower section of this range, making this already a unicorn setup, and we can call it a TWT setup. And at the same time that we broke structure, we create a valid supply zone protecting us from our stop loss, because our stop loss is here, and the supply zone is protecting us and protecting price from coming to your stop loss. Guys, this is a minimum of a 2% risk setup. This is a unicorn setup. And this was a 2 risk to reward. You know how crazy that is? I took this trade with a 3% risk because everything is aligning. Everything I just taught you from demand and supply chain creation. Oh, I'm always forgetting one thing, guys. What is the volume profile doing? The moment you break structure, you break back inside your volume profile. I totally forgot to add that, so my apologies. But yes, that is also aligning. So everything I have given to you, the moment we break this low, we got our mid time frame, okay, are aligning with our higher time frame. And the schematic itself, we have a break back inside our volume profile, we have a return to zone, we have a range inefficiency, and we have a supply chain creation. When you see this and your setup meets all the check marks, there is no reason for you to even doubt the setup, and you go triple down on your risk, 100,000%, okay? Because these don't happen that often. I'm telling you now, these don't happen that often. But you can see right here, and even my apologies, the break of structure right here, it was a 2.88 risk to reward, okay? Because right there is the break of structure. 3% risk on an almost 3% or a 3 risk to reward equals a 9% net gain on your account. I've given you the risk management tutorial. If you make 5% a week consistently, you're a multimillionaire. Now you make 9% in one single trade because all the stars are aligning. And setups like these give you a buffer for trades later on because now you have a 9% net gain in one trade, so you can lose 8 trades, okay, and you're still profitable. So it gives you a massive boost in your account. But we're only going to use those massive boosts if we have the proper confirmations. And we have all the confirmations here. Because, guys, in a setup like this, where there are reasons to come lower from a liquidity and a demand perspective, I always take around a 70 to 75% TP at the actual Wyckoff low, okay? But I will extend it down towards the range low, because there's nothing to hold price up, like I just discussed. That was one of our reasons from a context perspective. So we can let this trade play out, and you can see what happened. Do you see how easy this fill was? Look at this. You see how easy this fill was, guys. Look at this action. There's nothing here but straight vertically downwards candles, because there was nothing to hold price up in this area, because we had a range inefficiency and a return to zone. Nothing to hold price up. That's why the move down was so aggressively. Now, even more, there's nothing to hold price up in this entire range. So we're going to grab that range low because there's nothing but the whole price up. There's no demand, right? So price can stall around after dumping down this aggressively, but eventually this range will break towards the downside and that range low will go grabbed. And look at that. There you go. You see that? You right now have a 7 risk to reward setup on a 3% risk, meaning you make 21%. So I don't want any guy coming into my Twitter section of talking about it's unrealistic to make 5% a week consistently, because you can make 21% if you just held this trade, which was 100% valid. 100% valid if you know what you're looking for. And I'm giving you all the variables now. Okay, I'm giving you all the variables. This is, guys, this is a unicorn setup. Please screenshot this. Okay, please screenshot this. It's an absolute unicorn setup. Let me put it on the chart. Supply creation while breaking structure, came into pivot point supply, return to zone, range inefficiency, break back inside the volume profile. Unicorn. Absolute unicorn. Okay? Screenshot this. It's absolutely insane. Now, next we got Bitcoin. And this is absolutely one I love to talk about because it's actually the short of the current all-time high on Bitcoin, okay? Which was around like 73K-ish. and I actually shorted the all-time high on Bitcoin. It was when I first started my channel. I did not expect it to particularly be the all-time high, but I knew it had great potential. And I want you guys to see how you can actually short the actual all-time high to perfection. To perfection. Because price will give you the confirmation that's necessary. So right here was the old all-time high on BTC. Okay, right here was the old all-time high, and we exceeded it. We came up way too aggressive. Okay, we came up so aggressively. I was expecting some manipulation, some deviation to trap people. This is all publicly put on my profile, so you can fact check me all you want. But I was expecting a rejection. Okay, now I want you guys to look at what the actual high time frame top was on BTC. Actually, the all-time high. What was the all-time high? How did the all-time high? Listen, guys. How did the all-time high on Bitcoin create itself? The all-time high. You can short the next all-time high because it will be some sort of a similar distribution vibe. But now that you know what what you know based on what I've taught you, you realize like, oh my God, if I knew this sooner, that all-time high short was so easy. So we're gonna look at it, okay? We were trending up very easily. We were trending up. We had highs and lows, okay? And it was basically just this on like the 30-minute-ish time frame. Yeah. So we had an uptrend, okay? Very simple. And in an uptrend, we pull our range from top to bottom. Obviously, from a high time frame, from a context perspective, we went up so aggressively. Yes, we are in price discovery, but I was expecting a rejection. Okay, I was expecting a rejection, so every range had the potential of being a distribution. So, looking at the range that we created itself, we can clearly see that we have a range high and we have a range low, okay? And then we have a deviation 1 and we have a deviation 2. So you can already see that this is a Model 1 distribution, a TCT Model 1 distribution schematic. Now, I'm going to ask you guys, is there a return to zone in this schematic? Is there a return to zone? Yes, there is a return to zone because look at all these lows. We have a low, and we have another low, and another low, and another low, and a low, and there's no demand. There's no demand in all these lows. This demand zone is all mitigated, okay? All these tiny demand zones are all mitigated. So we have nothing but lows. There's no demand. And when there's no demand, that automatically equals some sort of a return to zone. Okay? So was there a return to zone? Yes, there absolutely was. Okay? So we got the return to zone. There's nothing to hold price up. Is there a range inefficiency? Guys, without me pulling my volume profile, you should clearly see an inefficiency right here. Where is the inefficiency? Right here is the inefficiency. There's no price action in the discount section of the range. All the price action is in the premium section. So if I pull my volume profile in this scenario to that all-time high right there, you can clearly see that we have our volume area low very close to that equilibrium, okay? I think if I even extended, you can see right there on the moment of entry right here, our volume area is equal to our equilibrium. But even without pulling my volume profile to confirm it, you can see that there is just no price action in this section of the range, even though this is 100% a valid range high and a valid range low. Because that's one more important thing, I want you guys to only look at ranges that actually look like ranges. You know, coming back to the rationality part about looking at ranges, I don't want you to pull any crazy range where we had like one wick and it's not a valid range, and then pull your volume profile and see an inefficiency. Now you can clearly see that this is a valid range, and it looks good like a range where this is your high and this is your low. It's just that there's a range inefficiency because all the price actions in the upper section and there's no prices in the lower section. Okay, so we got the return to zone and we got the range inefficiency. So we can already call this a TCT or a TWT unicorn setup. Range inefficiency, return to zone. It's already a unicorn setup. Now we can check, is there also a supply chain creation or just good supply creation, or or a break back at the volume profile. But even if we don't have that, and even if we have a singular break, we already have a 2% risk setup based on that combination of range inefficiency and return to zone. So zooming in into our market structure, we can see that coming into that third tab high, we had higher lows and higher highs. And then initially we tried to break it right here, but price kind of failed, okay? Because we wicked that low twice. So we wicked that low here, and then we wicked that low again, indicating no break yet, okay? Indicating no break, but just 2 SFPs. So our market structure low, our true market structure low was right here, okay? However, understanding the domino effect, you guys know that even though we SFP'd that low right here, if we get a structure break from this point to that point, you know, breaking back to bearish, that can confirm right here, that can confirm the rotation back towards this low. And if we break that low, that means that we can, you know, confirm the total TCT distribution schematic. So you can see how I'm using everything that I've taught you in all those trades, from the domino effect to range pooling to then also those high probability variables adding to the TCT distribution schematics. Now, looking at our structure from the low up, we can see a high, a higher low, a higher high, and then right here, we can see that break of structure right there. Perfect break of structure. So this break right here confirmed the rotation to this low, and then if we lose that low, we can go lower. But the way that price was setting up itself, it was basically just waiting for that confirmation, but you knew the confirmation was going to happen because the setup was so clean. Like this takes, what is like 6 hours to form? Oh, this took 22 hours to develop, right? And when something takes that long to develop, you know it's going to be juicy, okay? So what you can do is right now on that break of structure, that's where I already enter, okay? I already enter on this break and not on that break because I know this break will lead us to that low, and then from there we can go lower, okay? So we're going to check that break of structure, and we're going to check for our volume profile. Okay, so we can clearly see that we were hovering and we were deviating that volume area high on that retest, and we deviated and we broke back inside on that break of structure. So what do we have? We have a model 1, okay? We have a model 1 where we have a range inefficiency, check. We have a return to zone, check. We have a break backside our volume profile, check. And on the break, we created structure supply with an inefficiency because we had such an aggressive break, indicating that price is really ready to move down because we left an imbalance. So we got the not particularly supply chain, because not supply created supply, but it is supply creation on the break, okay? Good supply creation on the break that breaks back inside the volume area, and we have the range inefficiency and we have the return to zone, aka all the stars are aligning combined with high probability context, okay, because we are in an all-time high area, and then obviously we short right there on that break. And we can put our stop loss above our third tab high. You could even argue, guys, sometimes I'll even put it here, but that's for another lecture, okay, that's for another time. And I'll target that range low for a 3 risk to reward. Again, all the stars are aligning. We have everything checked off. So I'll take this with a 2 to 3% risk on this trade, meaning I'll make 9% when we hit TP1. But because I know this can have follow through, like I said, I'll take a 75% TP at the range low. Okay, so we have a 9% gain. I'll take 75% out, realizing around 5 to 6% on this setup, and I'll let the rest run, right? I'll let the rest run, and you can clearly see that this ended up being a crazy trade because this went very, very, very low, right? Very low. This could have been a swing trade, okay? And you can clearly see now that, you know, someone's like, oh, how did you short the all-time high? Well, now you know, right? Now you know. You just have to be aware from a context perspective that this was an area where you could put in that swing point so we can get a micro entry for a macro target. But again, guys, a 9% gain in a single trade, because it was a 3 risk to reward setup, but all the stars were aligning, so we double and triple down on our risk. So again, you can take a screenshot of this if you want. Beautiful. Model 1, break backside the volume profile, supply creation, range inefficiency, return to zone. TWT, amazing, guys. So you can clearly see now what I'm looking for when trading TCT schematics, and why I would double and triple down on my risk, and why I would kind of back off. Okay, so I've shown you two absolutely unicorn setups right now where everything was aligning. Okay, they don't happen that often, but when they do happen, that's where we profit from them absolutely, like, to the max. Okay, to the maximum we profit from them. But I would argue that they appear like once every, like, perfection like this, maybe once every 2 weeks. So realize that once every 2 weeks, a setup like this where you can make 10%, you can only wait for these setups, because that means you make 10% every 2 weeks, which is around 5% a week. So you don't need that many setups, guys. I'm telling you, wait for those high probability ones. Now, mind you, do not take the trade if you don't have everything checked off, because I don't even have everything checked off on 99% of the trades I take. Okay, oftentimes that return to zone is already enough for me. Okay, return to zone with a nice break back at your volume profile, and I'm running it if the stars are aligning. Okay, now let's go into another BTC short, which was an absolutely amazing short from the last bear market. Okay, so much as we don't want to think about the bear market, this was an absolutely amazing short, and it just gives me more confirmations into the next bull market of the trade opportunities that we're going to get. But we can clearly see that there was nothing like really that important from a demand perspective on the left, but we were, from a macro standpoint, obviously we were downtrending. Okay, it's not particularly 3-day structure right here, but we were downtrending very aggressively. Okay, we were downtrending very aggressively because we were in a bear market. Now, obviously, on any move up, where we move up with only liquidity, right? We have that slow grind up with higher lows and higher highs, where each higher low doesn't take out the previous one. We can see this buildup of liquidity. We're downtrending, so in general, we're expecting that lower high for that lower low eventually coming back to that low. We're gonna look for shorts. Okay, we're gonna look for shorts. So our mid time frames and high time frames are aligning if we look for a distribution once we get it, and you can clearly see that we got it if you're already scouting it, because it is on the chart right now. Now, in a local uptrend, we pull our range, or we pull our market structure from. Now, in an uptrend, we have from the low up, we're in the local uptrend, higher lows and higher highs, and when we have higher lows and higher highs, we pull our range from top to bottom. Okay, from top to bottom. Now, we can clearly see when I have this range on my chart, we have a high, we have a low, we have deviation 1, and we have deviation 2. So this is a high time frame, okay, guys? This is a high time frame distribution schematic. Boom. High time frame distribution schematic, okay? And from a macro standpoint, we were expecting a lower high. So it's the context, the high time frames and the mid time frames are already aligning. Now we're going to zoom in. Okay, we're going to zoom in. I'm going to extend this to this range high. Make these dots perfect. And I'm going to be asking you a few things already, okay? Do we have a return to zone in this macro range? No. We do not have a return to zone. Why is there no return to zone? Because we can clearly see structure demand right here, okay? That pump price higher. So this is definitely an area of support, 100%. And we also, technically speaking, have high time frame demand here. It's very ugly, okay? But it is some sort of demand. But no. We have no return to zone. We have some lows right here that can get swept, but I would not trade this as a confirmation with the return to zone in it. Now, what we do have, guys, is a range inefficiency. Because if we look at this range and we dissect it in the premium pricing section and the discount section, there is a clear price action gap here. Okay? If I pull my volume profile, you can see that it's very narrow, and our POC and our volume area low are very close to that equilibrium of the range. But even despite our volume profile, you can see a clear gap in price action here, where price, it kind of deviates into that gap and then we pump higher. But there's a clear price action gap. We don't have that in the upper section, okay? That's all full. Compare the price action in this box versus the price action in this box. There is no price action, even though these are valid range highs and range lows. So this is again an example of having a range inefficiency. And it's already spoiled right here, but look at this. This is what happens when you have a range inefficiency. Because even though you had some demand in here, the demand was backed by zero volume. And demand is basically an indication of buyers stepping in. But if there were a lot of buyers stepping in, that will cause a volume spike. And we didn't have that. So this demand zone wasn't good. So you can already kind of confirm how strong your demand is based on the volume behind it. Okay? But we didn't have that. You can see the range inefficiency fill was very easy. And this is what you will see most of the time when you're trading setups that have those inefficiencies. Very smooth fill, like a knife through butter. Now, talking about the actual confirmation itself on how to trade this, we can see that coming into that macro high that we deviated, we had our own little TCT Model 1 distribution schematic. Okay? Where we have a 1. Let's make it blue. We have a 2. And we have a 3. Okay? Absolutely beautiful TCT within TCT, allowing us to probably catch a trade in here and run it all the way down. Okay? So we're going to check it on the lower time frame. And right here, checking our structure, we can see we have higher lows and higher highs. And then right here is where we broke market structure, breaker structure. So this distribution itself was not a high probability distribution, okay? It was aligning with the higher time frame one, but here you had no clear range inefficiencies, you had no clear return to zone, you had no clear supply chain creation or supply creation because there was no proper inefficiency. It was all aligning with the higher time frame context, okay? So right here, you can still short it. The distribution itself, from a macro standpoint, has good context. It's in an area where a distribution makes sense. You have TCT within TCT, allowing you to get that scalp entry. We have a range inefficiency. Now let's check what our volume profile was doing. Let's check what our volume profile was doing on the macro range to see if that is in line with that break. No, that was way lower. Okay, that was way lower. So right here we have good context, okay, because it was an area for the lower high. We've got TCT within TCT giving us a higher entry and a better risk to reward. So that's very nice. Okay, that's very nice. And then we have a range inefficiency. That's a check mark. And then not particularly a return to zone. So would I double down on my risk in this scenario? Not per se. Okay, is it a valid setup? 100%. 100%. Because it could be a macro or a micro entry for a macro target. Okay, this is around a 10 risk to reward ratio trade. 100% valid. I'm not cheating anything. It's just a 10 or 11 risk to reward based on our entry confirmations. Okay, so absolutely what happened, you can clearly see it already, is that we got the confirmation here, and the moment we broke that actual range low from our local range in here, that was also the confirmation that the entire play was going to be put into action, and then we have our order flow objective being this range low. Okay, now guys, right here we have an example of a macro distribution. Okay, so if I go on the daily, you can clearly see this is a high time frame distribution schematic. A high time frame distribution model 1 with a range inefficiency. That's why this fill was so easy and this demand zone was useless because it was backed by no volume. But now we can check, was there maybe some Wyckoff trades in here that we can take because we know that we're trading in the correct bias based on the order flow objective being the range low. So any trades or any distribution plays within this and in these range formations are all valid. You can short a distribution in the upper section, but you can also short a distribution in the lower section because the main target is that range low and that hasn't been hit here. Okay, so this is a perfect example of trading price action when being in a high time frame move where the order flow objective hasn't been hit yet. And that's the best there is, because you know that you're trading and you're being on the right side of the market. So going on a lower time frame, we can check, hey, was there a little valid schematic in here? So what we can see right here is we had some sort of a range formation, and we had like a tiny model 1 accumulation schematic. Okay, tiny model 1 accumulation schematic that actually hit its target. Okay, let me put these dots here perfectly. So we had some sort of a model 1, and we had some sort of a return to zone, as I can see here, with all these highs being lower than the other one. And then price came up, the market maker grabbed all that buy side liquidity, deviated, and then reversed price down. Absolutely clean example of that liquidity lecture where we grab it, now he's ready to fill even more shorts and he's ready to dump it down. Wasn't a valid TCT schematic because it was only a 1 and a 2, but we can clearly see market maker pushing price and wanting to push price in a certain direction where the only purpose of this accumulation was to fill more shorts. Okay? From there, we created another range right in this area. And this is where I'm seeing something interesting, okay? Because looking at this range here on the 15-minute, I can see that we're trending down on the 50-minute time frame. And then locally, obviously from the low up, we are trending up. This is not 50-minute structure because you don't have the 6 candle rule. But right here you do, okay? So this is around 10-minute structure, 10 to 15-minute. And I can see a little range here. I can see a little range. And this range has a high. We have a low. Let me put that perfectly here. So we have a high and a low. We have 2 lows here that didn't grab the previous one. So we have some sort of a return to zone on the lower time frame. We got that deviation 1. And then we got that deviation 2. Indicating a TCT Model 1 distribution schematic in a pivot point supply area. So do you already see what I'm pointing towards? This is kind of looking like that distribution that we had here on Solana, where we came into that pivot point supply zone, and there were reasons to come lower, and we're getting a Model 1 distribution. Same here, we're getting a Model 1 distribution into that lower high area on the 15-minute, while trading in a confirmed high time frame Model 1 distribution. So your bias is correct. You're trading on the right side of the market when you're looking for a short. So now we're going to check. And we're going to check for confirmations, okay? Let me zoom in more. You can see here on the low time frame that we have a move up, a move down. And then right here, we tried to break market structure. Okay, we tried to break market structure. And it was very sketchy. It wasn't even a break, I think. Let me see. No, we SFP'd, not really a break. Let me go and see if we have a break of structure from the move up. Yes. Look at that. So we failed to break our market structure down here, but we know, even though that if this is a SFP, if we break market structure between this low and that high, that will still confirm that lower high for the lower low, applying the domino effect. Okay? So then we have a high, higher low, higher high with the 6 candle rule, and right here we got that break of structure. Okay, right there we got that break of structure, confirming the lower high for the lower low. So that's why I still go short, even though we didn't have a main break yet. Put our stop loss above that 3rd tap high, because that's the clear invalidation from a Wyckoff trading standpoint. And then we target our range low, which is already a 2.66 risk to reward. Would I double down on this trade? No, not per se. We did have some liquidity lows to be taken. Okay, we did have some liquidity lows to be taken. And we did came into a pivotal area on the chart. But the reason why I wouldn't particularly take a 2% risk is we didn't have a clear defined return to zone. We didn't have a clear defined range inefficiency. There was some sort of a range inefficiency down here, but not the best, okay? Not the best, but on the moment of the break, we did have some gap in here, which is nice confirmation. But I know that this trade can have massive follow through because we are trading in the higher time frame distribution, okay? We can check that we have a breakbacks at the volume profile. No, also no breakbacks at the volume profile. So we're entering on a lower time frame confirmation. It is in a crucial area on the chart, so the context is absolutely in our favor. 100% context is in our favor. And we're trading a distribution. We don't have the breakbacks at the volume profile. We have a return to zone, but it's not the best. We don't really have a supply chain creation, and we don't really have a range inefficiency. So it's just a distribution schematic with context that's absolutely in our favor. So not particularly a 2% risk setup, but it's definitely a high probability Wyckoff schematic, okay? Now, looking at the potential, guys, looking at the potential of this trade, following this downtrend, we came into the only supply zone there was, pivot point supply zone. So if we want to continue this downtrend, which is expected, okay, which is expected based on the higher time frame order flow objective, we could target, you could literally target down here. I'm not even kidding you. I'm not making this shit up. I'm not making this shit up. It's literally just trading a low time frame distribution in a higher time frame distribution. And look what happened. Look at that. This is that range inefficiency I was talking about. That's that range inefficiency. You see how clear that is? It's not weird to sometimes catch these 39 RR trades. It's not impossible. I'm showing it to you now. When you understand the bigger picture and you find that micro entry based on the same confirmation as the higher time frame, you can sometimes get those massive trades. It's 100% possible. I'm all about stacking lower gains and compounding them, but sometimes you have those boosts, you know? And right here you can see a normal Model 1 distribution instead of a higher time frame distribution that has a range inefficiency. So it's beautiful. What I'm teaching you is something no one looks at. People can look at deviations, people can look at SFPs, they can look at liquidity, but no one has gathered a system and a systematical approach like the composite trader. It's absolutely beautiful when you can align distributions, context, and you can have those confluences of price actually moving in your desired direction based on the TCT confirmation, but also based on the market structure, based on that volume area confluence, based on that liquidity confluence. It's so good. It's so good. It's life-changing good. That's what it is. It's life-changing good. Okay? So, on to the next. Okay? On to the next trade. And this is a perfect example of a trade that I took. I posted also on X for you guys, where I am purely trading the TCT schematic and not really caring about my high time frame context based on it being a high probability setup. So, I'm going to get into it. I think for many of people watching this is a very familiar chart. We can delete that distribution we saw at the top. But I think this is a very familiar chart for you guys because if you've been following me for a while, well, I started my public profile in this range. So for people that have been following me, and I think most of you guys have, you can see that we had this Model 1 accumulation schematic, okay? Model 1 accumulation schematic that went over into a Model 2, okay? Went over into a Model 2. And right here, we grabbed that extreme liquidity, confirming that third tap, okay? It met all the requirements. And now we just need to wait for that structure break confirmation to go back to bullish, okay? Let's put that there. Now we just need to wait for that structure break confirmation to go back to bullish. Let's zoom in on the 2-hour-ish time frame. And we can see on the 2-hour, we have lower highs. I'm skipping over these past few points, guys, because, you know, those are irrelevant now. We want to watch the most recent high. And then we have that low, lower high, lower low. Okay? So right here, we got that break of structure. Right here, we got the breakout structure. Guys, from a macro standpoint, this was super bullish. I also turned mega bull. I turned ultra bull on that breakout structure right there. Okay? I turned ultra bull because it was the moment to turn ultra bullish because it confirmed this high time frame schematic and we could have the rotation back towards our range high, our Wyckoff high. Okay? So high time frame, mid time frame, everything is bullish because we broke it back to bullish there, and also market structure from the low up was trending up. Okay, where we have simply higher lows and higher highs, just like this, on around like the 1 hour ish time frame, 1 hour to 45 minutes. It's kind of our structure pool here, 30 to 1, and from there we broke our market structure, confirming the high time frame distribution. And from there, we created a range, okay? In uptrend, we pull our range from top to bottom, and we have our range high, and we have our range low, and then we have rangy price action. So when I'm trading the low time frame, I always have to be aware of what the mid time frame is doing, right? Based on what I've given you guys, you can pull up that sheet. When I'm trading the low time frame, I also want to check what the mid time frame is doing. Now, the high time frame and the mid time frame are mega bull. Okay, they're mega bull. And we've created a local range. So when I'm trading the low time frame, preferably when I trade an accumulation, because from a context perspective, everything is bullish, right? Now, zooming in on this range, we can see that right here, I traded, identifying my most important structure pool within this range, which was basically trending up, okay? Trending up like this within our range. We have a local uptrend. I pull my range from top to bottom, and then right here we have that range. I have my range high. I have my range low. I have my deviation 1, and I have my deviation 2, indicating a model 1 distribution schematic. Okay, we have a very, very, very clear return to zone. Okay, there's absolutely no support, so it's a very clean return to zone, building up all the way from our low to our high, giving us that popping effect where we have this trailing up. Our deviation is getting tighter. Our deviation is getting tighter, and then this is that crucial point, is that decisional point, right? Where we deviated, and then that's that crossing area right here, what I told you guys in the lecture. It's that crucial crossing area. So when we break structure, right in that area, the move down will be fast. That perfect build-up. It was a perfect build-up. Okay. And furthermore, I'm checking my volume profile, and look at that. There's barely any volume in the lower section of the range. So right now, we don't particularly have a very clear defined inefficiency. There's some inefficiency here at the moment of waiting for that breakout structure, but it wasn't that clear. Wasn't that clear at all. But you can see right here on the volume profile, all the volume is in the upper section, and our volume area low is at the equilibrium. Okay, so zooming in, right here, we got our structure break confirmation. Okay, right there, breakout structure. We're going to check our volume profile again to see if that break is inside. Look at that. So what we're having now is we're having a low time frame. Okay, we're having a low time frame model 1 distribution schematic where we have the return to zone. Okay, and it was like this was a crazy return to zone build up because it was a build up straight from the low towards our breakout structure low. We got supply creation. Okay, you can see the aggressiveness from this 1 minute candle. Look at this. This is scalping, guys. This is scalping. Look at the aggressive reaction from this tap. We got that move up and the candle closed bearish. Very aggressive sell candle. We broke structure, creating supply. Okay, we can see the inefficiency. So we can see supply creation on the breakout structure. We can see a model 1. We have a return to zone. We have a range inefficiency, and we have a break back to our volume profile. So we have everything. On the low time frame, we have everything. Everything for the short, okay? Where we can short on the break and we can target the low. We meet all the confirmations. Then checking locally inside of this range, we have some sell-side liquidity lows below here, and we have some demand right there at the bottom of the range. So, even though our high time frame and our mid time frame are super bull, I am trading the low time frame, where I will only be trading the low time frame if it meets all the requirements for a high probability setup. Because I told you guys, when your low time frame is 100% against the mid time frame, which it is, because the mid time frame is in a range, but in a bullish range, because we're expecting this range to break up based on the macro context, I will only be trading a low time frame setup if the low time frame setup itself is a high probability setup. And we can see this is an extremely high probability setup because it meets all the confirmations. Would I double down on my risk? No. Even though we meet all confirmations, I would not double down on my risk. And I would just trade it itself because it's already a too risk to reward, and it's riskier because you're on a very low time frame. Okay, you're on a very, very, very low time frame. And overall, the macro context is bull. It is just macro bull. Okay, but like I said, for the low time frame, we can pay less importance and put less importance on the high time frame because right now, price can just come down, complete its distribution schematic, sweep those sell-side liquidity lows, mitigate that demand before continuing that higher time frame bullishness. Okay, so you can clearly see how a low time frame schematic is tradable, can play out, is valid to trade, while your high time frame is mega bull. Okay. Doesn't really matter that much. If your high time is mega bull, as long as you can get that local entry, where your local entry is a high probability schematic, which it was because it met all the confirmations, you can 100% trade it. 100%, okay? Now, another thing I want to tell you guys, and this is a sneaky little extra tip. People asked me, I remember this trade when I posted it, and people asked me, hey, why did you trade it as a Model 1? Because this is also a 10-minute range, and on the 10-minute range, your tab 2 and your tab 3 disappear, and it's just one deviation. Okay, it's just one deviation on the higher time frame, and this range is valid on the 10 to 15 minute. Now, the reason, guys, was the buildup. The reason was this buildup. Obviously, we got clean-looking structure, so we had clean-looking structure, so you can trade it as a Model 1. Even if you have a higher time frame single deviation and a lower time frame valid TCT schematic, the fact that it's a deviation or a single deviation on the higher time frame does not stop you from taking the trade. It's very important. It doesn't stop you from taking the trade. But also, I gave you guys in the lecture that example of that buildup. It's all about the buildup, right? When you have a buildup like this, this is crucial. This is crucial. When you have a buildup and price is trending and it's contracting, okay? It's coming closer and closer, and you get those deviations, and you get it again, and then you get that break of structure, confirming also that you leave this range. This is what you want to see. Your 1, your 2, your 3. It's this buildup. The moment you see this, price is primed to go lower. It's absolutely primed to go lower because it's been building up. It's been compressing like crazy. We got the fake outs above, which is the ultimate manipulation for the market maker to fill his shorts, and then we can get that reversal. And that's exactly what we had here. We had that massive buildup, right? This massive buildup with the deviations, just like we had here. That's why I took it. But either way, if you have a valid low time frame distribution schematic, that's a 1 deviation on the higher time frame, that does not stop you from taking the trade. You just have to be aware that, let's say price came back up one more time, you don't have a 1, 2, 3, 4. No, you can go in the 5 minute and you just have a model 1 again, and you can just trade it again. Sometimes you have to take that L to get the W, right? But that build up is so crucial. And this is, again, a prime example of your high time frame is super bull, your mid time frame is bull, okay? But locally you're ranging, so the high time frame and mid time frame bullishness does not matter that much. We're just trading the range, but we were only trading a high probability schematic, and that's what we did. And it's 100% a valid trade, also based on that sheet I gave you guys, where we're only trading that low time frame against our mid to high if we have a high probability schematic, which we had because this box met all the requirements. Let me see. Okay. Next, we got Euro. Okay, next we got a trade on Euro as an example, and this is a prime example of context. Okay, I wanted to put this trade in there because it's a prime example of good context building. So, what we can see here is that overall, right here, we were in an uptrend. Okay, so checking this, overall, we were in an uptrend where we had highs and higher lows. Okay, this wasn't valid structure because this candle did not take that low. Just double checking. Yeah, it did not take that low. These lows are different. So we only had one candle in the downtrend. So the low was not valid. Okay, so we're in an uptrend, and right here, we had this beautiful demand zone. And the reason why this demand zone was even more beautiful than it looks is because right here, we got this very aggressive dump. Okay, with this very aggressive dump that left this structure supply area. And you can clearly see how demand takes over, how you get that flip from supply to demand. It's always extra nice because it shows that pivot, that decisional point in the chart where the demand decided, hey, we're not going to be putting any lower high here. We're going to get the rejection, but demand takes over and we pump it higher. So it was a very crucial demand area. Okay, very crucial. Now, you can see the demand area got tapped and we flew away. But prior to that, price was downtrending. So even though we were expecting a lower high or we're expecting a higher low on the higher time frame, I was also expecting this demand area to get tapped. Okay, I was also expecting that. Now, what we did is we came up to our 2-hour market structure high and we started SFPing it. And we both know that an SFP is a potential indication that price will come back towards your market structure low, because the low failed to take out the high. Okay, basic market structure rules. We're applying everything. So the moment price comes to that high and we start SFPing it and we create a range, just like this. The moment we start SFPing it and we create a range, from a context perspective, we SFP'd our high so we can go lower. Okay. There are sell-side liquidity lows, and there's demand lower. So from a market structure perspective, we can expect lower price action. And from a liquidity and demand perspective, we can also expect lower. So the context, when we're trading this range, is lower. Therefore, I will only be trading an accumulation if it presents itself in this range, if it's a high probability setup. Okay? So, identifying and checking price action in this range, we can see that we have our range high, we have our range low. Okay, let's make that perfect. And then we got our deviation 1 at the bottom, deviation 2 at the top. Okay, so at this point, it could be an accumulation or a distribution. We got supply right in that pivotal point for our potential model 2. Okay, and then we got another deviation of the low. Now, would I be trading this Model 1 accumulation schematic on the breakup structure? No. Why? Well, right here we got that breakup structure confirmation. If I were to trade it, which is already riskier, we have no clear return to zone. Okay, we have no clear return to zone here. We have an inefficiency, and then we have some highs, but nothing is really valid market structure. It's just like a low time frame move down. We got a break, okay, and the break is all the way up here. Our target or our stop loss all the way down there. We have to be aware of the supply zone, so it's only a 0.93 risk to reward. That is not valid at all. Okay, we want to aim for that 2, preferably for that 2. So we extend our range. Okay, we can pull it down to that third tap deviation low. And prior to price coming down or tapping that supply zone for a potential valid Model 2, we came down with a return to zone. You see that difference? Oh. We came down right here, leaving a return to zone, where you can see price coming down, but all these highs here, we have a high, we have a lower high, lower high, oh, lower high, and some beautiful curvature itself here on the lower time frame. Okay? So now we have some form of a return to zone with all these highs here. So we can change them for our beautiful liquidity curve, low time frame liquidity curve here. Beautiful. And then if I go on the 2 minute, I'm just scanning, I can see this 2 minute order block. Now, we know a Model 1 can flow over into a Model 2, right? Model 1 can flow over into a Model 2. Now, right here, we had all these beautiful sell-side liquidity lows building up. Now, that was our extreme liquidity point. So if we tap that and or tap this 2 minute order block, we have our requirements for a potential third tap from a Model 2 perspective, okay, which we did. And then coming into that area, we got beautiful structure right here. Absolutely beautiful structure on the low time frame. We just had that perfect pullback, and then we broke structure. Now, what we have right here is we have a distribution, a potential distribution that's not confirmed, actually got front ran and came down, leaving a return to zone. We swept all sell side liquidity coming into demand and breaking structure back to bullish, confirming the Model 1 flowing over into a Model 2, already extended accumulation, showing signs of bullishness. Yeah. Now let's check what our volume profile is doing. Because right on that volume profile break, right on that break of structure here, we did not have a break back inside on that first candle, but we did get on the second one. And I would wait for that second one, okay? Because I'm trading a low time frame schematic where price action or where context is against me, based on what we just said about the market structure and the reasons to come lower. So I will only be trading, right? I will only be trading a high probability TCT schematic. Now, if I have my return to zone, that's check mark 1, okay? If I have my breakbacks at the volume profile, that's check mark 2. If I have demand creation, that's check mark 3. Do I have a range and efficiency? Check mark 4. We don't have a range and efficiency, but we can have a return to zone, and we can have a breakbacks at the volume profile, okay? We didn't have particularly demand creation because we didn't have a proper inefficiency. So instead of just waiting for the return to zone as a confirmation, I'll wait for the break back inside, so I have 2 check marks in the volume profile. So right when we get that break in that volume profile, we can target and we can go long. And obviously our first target would be that supply zone. And you can already see, like, hey, now I'm trading a setup that's already a 2.12 risk to reward, which is way better than at 0.93. So right here we had no return to zone and no proper breakbacks in the volume profile, okay? Right here, we have a return to zone, we have an extended accumulation, and we have a breakbacks at the volume profile. So you can give it a shot, okay? Because you know, hey, we also have a clear POI for the distribution. So if this really wants to dump, it will probably create a distribution. And then we can take this accumulation into the distribution based also on the advanced TCT lecture, okay? So right here, we got the break. We can long it up, and you can clearly see what happened, right? Price came into the area and even deviated the high. So what's beautiful is that now you have a trade. Okay, it was a winner. You could have taken 75% TP here. Wait for this low to get broken right here. Okay, because that was your market structure low to confirm a distribution. You can clearly see that did not get broken, and then your final TP at the highs would have been hit. Why would the final TP be at the high? Because we have been waiting for a distribution all this time. We've been waiting for a distribution all this time, right? Now, we got the deviation again, indicating a Model 1. Okay, we got that distribution, indicating a Model 1. Now, right here, we need to wait for a breaker structure. So you can see, what was it, around 2 minute structure. There you go. It fell to break, and it kind of broke better right there. Now, this model 1 distribution is aligning with context. Because we were SFPing our high, there were so many reasons to come lower from liquidity and demand perspective. So a model 1 makes sense. So do I need a high probability model 1 schematic based on all the variables that I've given you to go short? No. Because we're trading with the context. So we can just trade the model 1. So you can trade the model 1. You can put your stop loss above that high. And literally, you can have your initial target at the low, which is not the best risk to reward. But we know the possibilities of this coming down towards this low following basic market structure rules. And then look at what happened, right? But I want you guys to see the difference in the requirements that I put on trading this long versus the requirements that I put on trading the short. I'm only waiting for a break of structure here because I'm trading with my context. And I'm waiting for all these extra variables right here because I'm trading against the context. And that's again a reminder to that sheet I gave you. If we're trading on the low time frame against the mid time frame, I'm only trading it if it's a higher probability setup. So I had to wait for that break back inside and that return to zone in order to call it a higher probability setup. For the distribution part, nothing to worry about. Nothing to worry about because we're trading with the context. We were expecting lower. Now we just got the confirmation to go short and we got the invalidation and we got the target. And then boom, very easy. You can see right here, as fast as we can come up, as fast as we can come down. Sweeping all these lows and then mitigating demand. It's absolutely perfection, guys. But that difference, I want you to put importance on that difference I just shown you about the requirements I put on the long versus the requirements that I put on the short. I'm only waiting for the break on the short and I'm waiting for much more on the long because the long side is riskier, but it's still tradable. Still tradable. Lastly, I want to show you guys a prime example of context again, because context is so key. Now, we had this massive range on euro, okay? That's the only thing that you need to know. It's just a massive range on euro. We were trending up, okay? You can ignore this. This was also from a lecture for you guys, but we were just trending up, and all you need to know is that we're in this range. Now, what happened once we got that range high deviation? You can see how aggressively price dumped. You can see the 6-hour candle. It wicked it, closed bearish, it dumped. Okay, dumped down. Now, the moment we have a high time frame, potential high time frame distribution, okay, we can see right here in that high time frame distribution, we got this supply zone. Okay, beautiful. We got this supply zone. I think it's also, is it the 6-hour? Is it the 8-hour? It's around 4 hours the most beautiful, okay? But you can clearly see even just from a structure perspective, we went up and we broke structure and we left that inefficiency. So you can call the 4-hour order block. You can call it structure supply all you want, you know? But it's basically also a 2-hour. It's a bit more refined, but I would just use this entire area. When you're trading such a high time frame distribution, it's like it could be a daily distribution schematic, right? On the higher time frame, right here, it could turn into a daily distribution schematic. So when we're trading a high time frame distribution schematic, I am not refining my demand or my supply zones down to like the 30-minute order block. No, I'm just taking that generalized area because we're trading the higher time frame. Okay. Now, what price did is we came into that high time frame supply zone, and from there, okay, we started a downtrend. In a downtrend, we pull our range from bottom to top, and we started to create something that was looking like an accumulation, okay? We started to create something that had a 1, that had a 2, and we had a 3, okay? Now, also going on a lower time frame, we can check, and we got that break of structure confirmation right here. On the 2-minute, right here. Break of structure confirmation. Now, you came into supply. And the reason why I'm going over this example, because I told you guys that if you're trading around a mid time frame accumulation, right, against high time frame bearishness, I want you guys to look, is there a reason for price to come higher? And in this case, like I said, there was more refined supply up here. So what I gave you in the lecture, I gave you a thought process idea of where you can say, we have the Model 1 here, and the purpose of this Model 1 could be to come towards a supply zone and then dump from there. But it has a reason to come higher. It has a reason, okay? Because that supply zone is still there. I told you guys that from like a structure perspective and a range perspective. That goes out of the window when I'm trading, when you're trading against a high time frame distribution. When you're trading against a high time frame distribution like this, and you come into that POI, like I said, I don't care about refined supply areas, okay? Because such a high time frame schematic, that 4 hour could be enough. You can see how aggressively they dumped price down. This wasn't like a news event. It was just them dumping price from that liquidity sweep. So you're trading here, not just against a supply zone, you're trading against a potential Model 2 distribution schematic. So even if there is supply above you, that supply is not required to be mitigated in order for the distribution to be valid. So you're trading a potential accumulation against a high time frame distribution in the premium section of the macro range. So even though there are signs of an accumulation, right? In this scenario, I don't want you to say, hey, we can come higher before dumping down because there's still supply here. If you're just having a market structure downtrend and there's supply up here, you know, and then you create here some sort of an accumulation, yes, you can say that that's the case, okay, for this the lower high, for the lower low. When you're trading against a distribution, I don't want you guys to risk it, okay? I don't want you guys to risk it. Because what happened here is that you have the accumulation, you have the potential of price coming higher because you have the supply zone, but you already mitigate high time from supply, which is valid enough for the distribution. Now, looking at the range itself from the accumulation side, we got that break of structure, and you had some sort of a return to zone, okay? You had some sort of a return to zone right here. And you got that break. So we had some sort of a return to zone. And let's check the volume profile. If it can load for me. Come on, trading view. Okay, it truly doesn't want to give me the volume profile. But as I can see right now, you don't really have an inefficiency. Okay, there is some gap of price action in here at the moment that you're entering, but it's kind of that price, you know, it had this up here and it had this down here, so it kind of had price action in both areas. But we had some sort of a return to zone. Okay, we didn't have a break back at the volume profile because I don't think the volume profile is going to be down here. Okay, it's giving up on me right now. Let's check it one more time. Not truly giving up on me. That's fine. But if you had this in a different context, I would say this could be nice. But because we already mitigated supply zone, I'll be very sketchy. Now, let's say you still traded this, which I wouldn't suggest because you're trading against a high time frame. You know, you're trading against a high time frame distribution. So basically what you're telling me is, I hope the market maker wants to push price up a little more before we start dumping massively. That's what you're telling me. I hope he can push it up a bit more before we start massively dumping. Why not just wait for the dump side to confirm and look for the short? Why hoping that he pushes up a little bit higher before we start dumping? Because you have a distribution, right? So I wouldn't suggest that. But even if you did, we have some sort of return to zone here. But you definitely have this 10-minute order block that you need to be aware of. So it's not the best return to zone because in a good return to zone, you don't want an order block. But right here, you have an order block, and that's literally on Asia Open at 2 a.m. UTC +2, meaning Asia Open and push price lower. So you definitely have an order block that you need to be aware of. So it's not the best return to zone. So overall, this accumulation schematic is not even a high probability schematic. So you're trading a 0 high probability schematic against a potential high time frame distribution area, okay, and a distribution range. And even if you still took it, right, even if you still took it, which I wouldn't suggest, the moment you come into that supply zone and you see a 1, and you see a 2, and you see a 3, and you see breakout structure this aggressively, leaving behind this supply zone, it's a no-go. You de-risk ASAP. Because that just means that he didn't grab all liquidity. That just means he grabbed this local liquidity right here to mitigate supply to push price down lower. So even if you still took it, your entry would have been here. The moment price was right there, you put your stop loss to entry and you wouldn't lose any money. Because that's the other aspect, guys. You don't have to be right all the time, okay? You can be right for a moment in time and then de-risk. So even then when you are wrong, you know, from a higher time frame perspective, because you were expecting price to go higher, you will still not lose any money, okay? Which is also very key in trading, where you can keep your losses minimum and then your winners big. But the moment you came into that supply zone, right, it's a no-go. But this was more of a mid-time frame schematic, okay? And I told you guys, hey, if we have supply up here, you can still argue that you can trade that mid-time frame schematic, and it doesn't, you know, it doesn't have to be a high probability schematic. Checking off all the boxes, but I want you guys to know the difference between still supply remaining up here when you're trading just a lower high or when you're trading against a potential distribution. For a distribution, things are trickier. The funny thing is, guys, is that looking at that 45-minute supply zone up here and then looking at what price did is pretty funny because we went higher to mitigate that supply zone and to go lower. It's really funny that it still did that even though it failed the first time. So you can see the thought process that I normally have, right? You can see the thought process that I normally have, like, hey, there is a reason to come higher, so you could potentially trade this accumulation to go higher before going lower. It's just not worth it when you're trading against a distribution. It is worth it when you're trading against just a trend, but a distribution is a different breed, okay? And I even have a short from there, right? I took big profits on the close of the weekend, but you can see right here on that breakout structure, right there. Now there was no reason for price to come higher because all supply was mitigated, right? So I'm potentially holding this short for a 15 risk to reward, okay? Because we can clearly see some sort of a return to zone in here with all these lows being higher lows. And I can see a gap in price action right here. So I'm like, hey, this could be a massive runner. So I'm still in that short at the moment based on this high time frame model 2. The confirmation in here, and then some sort of return to zone and a range inefficiency on the macro time frame. So that I wouldn't say that's kind of confirmed because it's such a low time frame break. I would really say it's confirmed if we start closing good below this low. And that would mean that if we start closing good below this low, any price action or any range formation in this area is very tradable from a distribution side because we know that, hey, it could just dump down. And then you have that Bitcoin effect, right? You have that Bitcoin effect where you trade the distribution where you're trading in favor of the high time frame order flow objective with watch the model 1. So I'm doing the same here. High time frame order flow objective is the model 2. And then we can trade potential distributions in here being on the right side of the market. So these were all my examples, guys, for you to just show you what a unicorn setup looks like, you know, where we have to break backset the volume profile. We have supply creation. Context is in our favor. We have to return to zone. We have the range inefficiency. If you can combine these variables and make a systematical approach of, hey, when I have that range inefficiency and when I have that return to zone, aka a TWT setup, I double down on my risk. If I also have a supply chain creation that breaks back to the volume profile, I triple down on my risk. If I only have a return to zone, I'm just doing a 1% risk, right? As long as the context is in my favor. But these 4 variables that I've given to you guys are game changing. And I can already tell you now that only trading high probability setups is the way to go. Okay, it takes stress off your shoulders, so you'll live more years. But it's absolutely key that once I realized that I can take a trade like this, where I'm not even kidding, 100% confidence in the trade working, I'm like, I don't ever want to trade anything else. Why would I? When I can wait for these high probability setups and make 10% in a single trade. You don't need that many trades to become very rich, okay? Or just financially free in general. So I was like, when I can have setups where I just literally I have 100% confidence, why would I want to trade anything else? So play around with this, guys. Go and practice. I'm giving you the information, but you're only going to become good if you practice and put in the hours yourself, okay? So take my advice. Go practice. Go find trades. Go to the backtesting session, right? Go to the backtesting session and see me apply the trades on different trading and live trading examples, so you can get that experience. And then we're gonna be nailing the charts together every day. Okay, so peace out, guys, and good luck. See ya.